Three, two, one.
Oh, ladies and gentlemen, welcome. My name is Judah Hoover, and this guy right over here is Josh Weidman. This is the Build and Grow with Real Estate Show, where we talk about how to not only make a vocation from real estate, whether you are a realtor, a hard money lender, an appraiser, or a home inspector, or somebody who sells insurance. There's a great number of ways that you can make money from real estate. There's also a ton of ways that you can profit from real estate and build long-term wealth. And we think that real estate is one of the most stable, tried and true methods. And the things I love about real estate, Josh, is there's a lot of other things out there like fungible tokens and currencies and non-fungible things and there's day trading with Robinhood stock and all these other things that recently come out. And I love real estate because it just has the ability to be consistent and predictable and knowable, but it's also there's tons of ways to get creative with it. And so that is some of the it's not just invest and hope everything goes well and just not doing it. There's a bunch of different ways you can do creative real estate deals.
Yeah, well, that's the interesting thing. We're talking about finance today, but the truth of the matter is that finance is one small piece of the puzzle. Last week, I was talking to a potential borrower about a project that he was looking to do. His business model is something I never heard of before, right? So watch this. He goes out and he finds properties with old factories on them. And he was looking to raise $7 million from his existing portfolio, looking for a loan on the old Bishop McDevitt High School, right?
Nice.
So this guy bought that thing for almost nothing.
Right.
And
it sat there for forever.
Well, right. And he ended up leasing it out to a guy who from Milton Hershey School who played professional football and is now developing a lot of Harrisburg into affordable housing. And I'm not talking about low-end housing. I'm talking about affordability for working families, right?
Right.
Well, his business model, so the guy that owns the building, his business model is to buy these large projects with old manufacturing plants on them. And what he ends up doing is he'll go in there and then salvage the buildings and take out all of the metal. So we was buying this place in Texas for $7 million. The cost of the cost of the land is like 43 acres. It was like $5 million. And then he had $2 million that he had to bring to do the demo. Guess how much he's taken out of there in salvage? $22 million. $22 million. And he's done this before on a couple different locations. Like it blew my mind. He's telling me about this. I would love to I'd love to explore that. But in the context of our discussion here, it always amazes me. Every time I think I have it figured out, somebody comes out and says, oh, well, I do it a little bit different. And that little bit different, it's like it opens up a whole new avenue of opportunity, if you can explore that. So
yeah, it's fun to be doing deals right now in this market because it's such a hot market, and we've got the ability to be creative and still do deals to I think we don't realize how great and how hot this market is. We forget just how hot it is. Like I listed a house for a good friend of mine on Thursday. Well, I mean, I listed it 2 days before that, but I put a 48-hour showing restriction on it for a number of reasons. And so Thursday was my first day of showings on this property. And Thursday, Friday, Saturday, and even Sunday, I had 5-6 showings every single day.
Yeah.
And Sunday afternoon, I'm getting together with my friends, and I was like, I don't have any offers on that house yet. I wonder if everything's okay. I wonder if I did something wrong. I didn't misprice it, did I? Well, sure enough, 3 people called me while I was there at dinner. And saying, to give me a courtesy call that they were writing offers. I got a bunch more offers. And now this morning, everyone's texted me saying, hey, when are you reviewing offers? When are you reviewing offers? But in 3 days, I was panicked. Oh, I don't have an offer on this house. What's wrong?
You know what? When I first started flipping houses and not the 3 that I lost money on, but actually did it making money, right? I had there was a friend of mine who was a really seasoned investor, and I had the same panic. We list the house and you have a couple showings, and this isn't even in a hot market. This is just a normal market.
Right.
But we're like 10 days in and I'm ready to drop the price like $25,000. In talking with him, he says, listen, just relax. 30 days. Give it 30 days. You either figure it out, you either did it right or you didn't do it right when you listed the property, but you don't really know for 30 days. And you know what? In this hot market, it is a little bit of an eye opener if you don't have, contracts flying in, but that's normal. And
I had an offer on a different house that I listed. I forget if we talked about this last week. I had an offer. I had a showing on one of my listings on Tuesday.
Yeah.
And I had a showing on Tuesday, but an offer came in on Monday. They said, hey, listen, we're going to go ahead and make an offer contingent on us liking the showing. Just so you know, we're gonna get an offer in already. Just so you have it.
Yeah, it's awesome. That's good stuff. That's good stuff. So, I mean, look, over the weekend, you sent me an email. I was reading a couple articles that really jumped out to me. And over the last couple months, well, certainly weeks, but also months, I've been seeing some really interesting things in the hard money space that I've been wanting to discuss, but I haven't really had a context to do it on the show. And I think today is a great context to dig into a lot of this stuff, because today we're going to talk about changes to financing, one specific aspect of being a real estate investor, or for that matter, being involved in real estate. Because what was it in Pennsylvania? We had the highest percentage over the last in 2020 of cash sales in a long time, and it was only like 38%.
Right. It's a pretty small percent. What's funny though is the percentage of like cash sales that are close to the median price is way up. So let's dig into content here, Josh, while you're bringing that up, just so everybody knows. I'm a 20-year real estate investor and a realtor and an executive in a property management company. Josh, who's now above me, is a real estate investor for a long time as well, and he's a hard money lender. So both Josh and I personally, but also through our clients, see a lot of stuff. We encounter a lot of stuff, and that's kind of where we get the content that we try to bring to you. This isn't just regurgitated stuff that we see in books, tapes, and seminars. This is real, actionable information, and that's what we try to do here on Mondays is bring you guys the latest and greatest of what we're seeing going on in the world.
That's right. All right, so let's jump in here and get started. By the way, if you are looking for a hard money loan, or you're looking for somebody to list your house, right at the top of the screen here is all of our contact information. Feel free to reach out. But let's take a look here. All right, so we're going to get started with our content piece. We titled this New Financing Trends and Regulations, Adapting to an Ever-Changing Environment. The first point of contention here is interest rates are on the rise. Now, this is a big deal. It's a big deal for a number of reasons, but not the least of which is that a lot of the growth that we've had recently, in my opinion, has been caused by, lower interest rates. Would you agree?
Yeah, I mean, I think that ease of financing has certainly been a chunk of what's caused the ability for people to be buying in the housing market.
What's up, John? I never miss a Monday. I love it.
Yeah.
So, all right, a year ago, right before the COVID shutdowns, on March 18th, the average 30-year fixed rate on a mortgage was 3.88%.
Right.
Which is not bad. I mean, that was a trend of dropping interest rates even then. Right. Well, fast forward to today, we're looking at 3.23%, which is lower and seems pretty attractive. If you don't take into consideration that in January, it was 2.93%. We're talking about a pretty significant drop over the course of a year, almost an entire percentage point, right? Almost 100 basis points.
Right.
And now we're back up to over that 3% mark. I mean, it's been over the last 2 weeks, it's jumped a lot. I mean, went from just about 3% and we're up 23 basis points since then. If that trend were to continue, well, let's talk about first what that looks like today. If you're a buyer, what that means to you is it's going to cost you $16 per 100,000 borrowed every single month for the next 30 years.
Correct.
It's a lot. I mean, it doesn't sound like a lot, but when you have a median home price of $300,000,
yeah, I mean, if you're buying a $200,000 house, that's $40,000. I mean, $250,000 house is kind of the middle here. I mean,
yeah,
$50 a month is we're starting to add up and talk about some real money.
Well, right, and I don't think $45 or $48 a month is going to change anybody's buying decision today.
Right.
But if that becomes $100 or $150, now all of a sudden that's a pretty significant difference, and that's gonna play out a little bit different. Certainly on the lower end of the housing market, we may see some dampening of the market if this trend of increasing rates continues. And investors, I think the big takeaway here for investors is really to make sure that they're anticipating a higher interest rate.
Well, yeah, it's important. It's important also to recognize that what Josh just said is very, very critical. So the lower end of the housing market is what's the most affected by this, because those people tend to stretch their buying dollars as much as possible.
Right.
So whereas somebody in the median housing market of like 250 to 300 to $400,000, they might qualify for a $500,000 house, but only buy something that's 450. At the lower end of the price, which is where a lot of the stability in the housing market comes from.
Yeah.
People going from being tenants to being owner occupants, and then also people moving up, and that move up being absorbed by former tenants. The bottom end of the housing market is where all the stability comes from. Those people, if they get qualified for a $120,000 house, that's what they buy. If they can get qualified for a $126,000 house, that's what they buy. And
yep.
so every little bit of payment makes a difference there.
That's right. And I mean, I think the real takeaway here from this specific bullet point is, hey, pay attention.
Mm-hmm.
Pay attention. The last time we had interest rates at the 3.25% range was August of 2020. If you're an investor and you're saying, okay, I'm going to flip this property, and in January a house sold for $350 in your neighborhood, maybe $350 is not the price.
Right.
You might want to look in that area and see what sold in August, just so you get an idea of where that number might be. I think we're still dealing with low inventory, and that's got a big part of this. That's a big part of the story here. But one thing, if you're an agent, one thing that you might anticipate here is, a slowdown in demand. And like Judah said, you only have 2 offers in over a weekend as opposed to 20. That's still a pretty good position to be in. It's not a major change to the housing industry, but it's something that you got to keep an eye on. Right. All right. So this next item Judah found. I'm going to let you play with this one because I think this is a big deal. I don't think people realize it yet.
So FHFA is the government agency that manages and offers oversight to FHA, PHFA, Fannie Mae, Freddie Mac, all of those institutional lenders. And they are telling bankers that they want their portfolios, that what they're issuing every month for mortgage-backed securities and things like that. They want that volume to be no more than 7% when it comes to second homes and investment properties.
Yeah.
So, and they were hoping, the industry was hoping that FHFA would delay that until 2022 sometime, but that rule goes into effect in May of this year.
Yeah.
So I've talked to some of my friends who are in the lending world, and they've said that they've seen 200 basis points. So it takes 100 basis points to equal a percent. So, 3.5, the 0.5 is 50 basis points. 3.55, that other 5 is 5 basis points. So I've heard talk of pricing adjustments if it's an investment property, 200 basis point adjustment for investment properties if you were going to go to your local bank. Because you and I know, Josh, it's complicated, but I mean, basically you can do 10 plus your own primary residence, in your own name by 10 rental properties, get a 30-year fixed. And before you start doing LLCs and a bunch of other stuff like that, there's a whole concept there and asset structure that we won't get into, but that's by and large what a lot of people suggest you do. Well, those loans are about to become a lot more expensive.
Well, let's talk about that a minute. I think it's important to understand the why. Why the heck would FHFA do something like this when, why would they do something like this at this point in the market?
Yeah, that's a great question. So the reason,
go ahead. Sorry.
The reason that they're doing that is because they want to limit the overall market exposure to people buying and speculating on second homes and investment properties. Because when the real estate market gets hot and people say, oh, great, this is something I can do. I'm going to stop speculating on Bitcoin and I'm going to start speculating on real estate. When there's a bunch of speculation going on, it makes it seem that there is more housing demand than what there actually is. And then we can see a bubble. So real estate investment is great, and there's a spot for that in the marketplace. Some speculation can be okay, and you can make a lot of money speculating in real estate, but you can also lose a lot of money speculating in real estate. So what FHFA is trying to do is saying, hey, look, if you want to speculate, that's fine. But government-backed and government underwritten and government-supported money is not for speculating in real estate. So we want to limit the amount of that we're doing. These agencies were originally created to help, median and low income individuals get housing and make sure that there was housing available for all. It's not to be used as a wealth creation tool and that's coming from a guy who loves real estate as a wealth creation tool and loves all those things. I'm not saying any of that's bad. It's just not what these programs were originally designed for. And so the government is trying to say, hey, listen, like let's limit our exposure to this. So the immediate impact is, conforming lenders that like paper stuff is likely to shift a lot of their focus. And investors are going to have fewer options. What they're going to do is they're going to go to non-QM. There's a thing called a qualified mortgage. So they're going to go to non-QM mortgages, which is funny because when I was getting started, we called all that stuff subprime loans. So we did away with subprime loans, and now we just call them QM loans, not QM loans. You know what I mean? But I thought we didn't do subprime anymore. Oh no, we don't do subprime anymore. We call it non-QM. That's what we do. We've just given it a different name. It's essentially the same thing. Now there's not stated income so much associated with it, but there are a lot of like 12-month bank statements out there. And this is the other thing, by the way. I was actually just talking with one of my former lending partners this morning, and he was telling me just how much Fannie Mae and Freddie Mac are being very critical of self-employed individuals. They want to see a 2-year bank. They want to see 2 years worth of tax returns. That's very common. They also want to see a year-to-date P&L, and they want to see bank statements to back up the P&L. And if there's any like discrepancy there, they're just going to go by, the lower number. So like Josh, if let's say you work a W-2 job, right? And you get some overtime and some other things like that. And so let's say you made, 50 last year and you made 40 this year. They're going to average that and say you make $45,000 a year. That's what you can, borrow based on. They're going to look at year-to-date income and make sure that that's still consistent, whatever. If you're self-employed, they're going to say 40, and we're going to use 40 as your income. Just being really critical about that. The reason that's important is a lot of real estate investors are self-employed, and more and more people, whether they're they're looking to get into real estate investing. They are self-employed as an investor or self-employed as something else. And we're moving more and more into a gig economy. We hear that all the time.
Yeah.
So it is, W-2 income still is the gold standard. And it's sought after for a whole bunch of reasons. And you shouldn't take it lightly if you do have a nice W-2 paying job. The other thing to think about is, if you're kind of like let's say a solo entrepreneur, right? Let's say you're somebody like Josh Weidman, and you've got a branch, and you've got this thing that you've got going with hard money bankers, and you can take some money as profits, and you can take corporate distributions and all this other stuff like that. It might not be the worst thing to actually put yourself on payroll and give yourself, if you're a realtor out there making a bunch of money, it might not be the worst thing to keep that money in a savings account and just give yourself a payroll every month. Could be a very good thing to do as well.
Okay, so yeah, let's talk about the immediate impact, right?
Yeah.
So immediate impact is that in May, if you are an investor and you have a relationship with a bank who typically refis your rental properties, you're either going to have an A++ credit profile and tons of documentation, and you're going to have an asset that is, without question, a laydown, right? Or you're not going to get a loan from a conforming lender. What this is going to do immediately, and if we rewind 2 years, 3 years, 2 years, 3 years, there are a ton of commercial lenders out there that would love to step in and grab these loans. When you're talking about conforming loans at 200 basis points higher than prime, and there are a ton of lenders that would love to step in there at 1.5%.
Right.
And what we saw, we had similar regulations that were implemented, I want to say like 3 or 4 years ago, that kind of phased out over the last 24 months. And what we saw is a lot of commercial lenders stepping into the space specifically for like burr investors,
Right.
where they said, you know what, I want to do the takeout loans for this. I want the 30-year fix or a 20 or 25-year fix. What you're going to run into is a lot of this commercial loans are going to require 25 or even 30% down. So the takeout financing is going to be a little bit less desirable. They're going to be more expensive. And at the end of the day, you're going to have to be more selective to be able to do 100% cash out refi on a burr type investment.
Oh yeah,
right. And then future projections. Look, this stuff comes and goes. It's like the tide. We'll have regulation for a while, and then all of a sudden the regulation will be pulled back or disappear or whatever. Long story short, you just have to have a lot of options for your takeout financing as you move forward. Look for the best terms, the best rates, and keep an eye out.
Yeah, and just be ready to understand that if you get turned down, you might need, whether you have a whole bunch of options lined up ahead of time, you just might need to go through more options and be ready, willing, and able to burn through and do the work and apply it, and then apply again, and then apply again, and shop around.
Well, okay, so let's talk about that, Judah. I mean, that point specifically. Here's what I think that we're going to see more than anything else. You're going to have commercial lenders that have really awesome rates and terms, and you're going to have a lot of them, but they're going to be very specific to the types of investments that they want to be involved in. And so you might get a turn down from, ABC lending company, but that doesn't mean that you can't go over to, BCD lending company right across the street, and they're going to love your loan where ABC lending company hated it.
Yeah, that's an excellent point. That was the niche I filled in the lending world when I was there. I was a boutique commercial lender because I knew who was looking to lend on what at any one time. Absolutely.
Okay. There you go. All right. So the last point here that I wanted to take a look at, and this is something that I've kind of been feeling in the industry as I've talked to people, as I've been watching, what's been happening in the market and everything that's been going on, is hard money is changing. A year ago, what we had, excuse me 1 second here. Sorry, we had a little one come in here and trying to distract me. All right, so if early 2020, you could go out. I started seeing hard money products hitting the market that were like 1 point origination and 9% interest.
Yep.
And then a month after these loans started coming out, they disappeared. All of the lenders stopped lending as soon as we had the COVID shutdown, and they're like running for the hills. And the only people left lending are small local lenders like us. While we have a lot of funds, to compete with the larger lenders, we focus and specialize in areas around our offices, right? So that we can go out and see the properties, and we know the markets, we know the players, we know, the local trends that are happening. Well, now we've had 9 months of a really awesome real estate market. And the result has been that a lot of these institutionally backed and bank-backed lenders are coming back into the market. They have been very much more aggressive on their loan to values and terms as far as what they'll lend on, how much they'll lend, what their points and origination points and interest are going to be. But they've been very conservative with the types of properties that they're lending on and the type of borrowers that they're lending on. So here's what I'm seeing a lot of. I'm seeing a lot of advertising for national lenders. I'm seeing a lot of people that are saying, hey, look, we'll lend you 80 or 90 or 100% of the cost of the investment. And then when the rubber hits the road, 2 or 3 days before settlement, they're calling up people in Central PA and saying, hey, I'm sorry, but your house is a rural property, and so we can't lend on it. Now, meanwhile, rural, I looked at a place in New York that we were looking at funding where that's exactly what happened. The lender backed out of the deal about 3 days before settlement. We got called in. I went and looked at it, and we made an offer to lend on it. But the whole problem was this isn't a neighborhood. Like there's 300 houses in a planned community, but because of the location in York County, they're like, yeah, sorry, it's rural. We're not funding it. I think in Central PA specifically, we're going to find a lot of that going on.
Right.
And are seeing that. So what you're going to see is, the immediate impact. These larger hard money lenders that are nationwide, they're going to start to make inroads on projects in consistent areas in Central PA. And what I'm talking about is in a neighborhood where, the comps range from 340 to 360, and that's it. And the 340 is like a big fixer upper. The 360 is a renovated property. If you're able to find a property in that neighborhood for 200,000 or 180,000 that needs 50 grand in work, they'll fund it. But if it's not specifically, a really consistent, very obvious area, you're going to be working with local lenders like HMB, like, some of the others in Central PA that are out there that know the neighborhoods and can move a lot faster.
Right. They've got to know the neighborhood. It's like the old Professor Hill from the Music Man. You got to know the territory.
That's exactly right. That's real estate. Location, right? Yep. So what's this mean to investors? The play for investors here is that you got to be realistic about your project and realize that financing is one important part of that whole package. If you need speed, you're not going to get it from a national lender. If you need the lowest possible rates and timing is not that big of an issue for you, you want to go to a national lender. Like, look, they're my competition, but I'm saying it right now. And I tell people this all the time when they call me. Like, look, we are perfect for some situations. Other situations, we're a terrible idea. It's right. Like that with any lender. You have to know what is best for you and your project. And I think that in the future, what we're going to see more than anything else is you're going to see a lot of institutional lenders totally dropping out of the market. Now, their model is geared and focused on volume. They have to lend out $50 million every single month or $100 million every single month. Their margins are super thin,
Right.
and they're geared towards volume. That's great in a very consistent market like the normal housing market. It's going to vary a little bit, but there's going to be light fluctuation. Whereas with hard money, what you end up with is in any pool of borrowers, you're going to have those people that are not able to perform. Things happen, right? And if you have somebody that knows the market well enough that they know, hey, if this deal goes bad, we're still going to be all right. You don't have that with the larger lenders. And the reason that they had such an immediate pullback during the COVID shutdowns is that they were fearful that, hey, we've been loaning 80% of the ARV here for the last 2 years. And now we're in a situation where we're overextended on these loans. The last 9 months has helped them absorb some of that, aggressiveness, but they're right back on track doing the same things. Local lenders, I'm biased, right? I am. But local lenders, they're going to know the market. They're going to be able to move quickly. They're going to be able to get you the financing that you need. And in some cases, they're a little bit more expensive, but we're not talking a lot. We're not talking a lot more expensive. We're talking about a few $1,000s over the course of a project. And sometimes for speed and efficiency, that's the way to go. And that's my take.
That's a great take. Well, listen, I think that's about all that we have here for today.
Yeah.
So, ladies and gentlemen, share this video with your friends and tag your friends in the comments. We really appreciate everybody who is here on a regular basis and checks us out. And Josh and I are just two dudes who know this market inside and out and know what's going on. And we're just here trying to help you as much as we can. So if there's ever anything that you think we're missing, or you ever think that we should be doing a show topic different than what we are talking about, don't hesitate to reach out and let us know. We'll be back here on Thursday and Friday of this week. Till then, see everybody. Have a great day.
All right, guys, go make some money. Take care.